Hello everyone, today we're going to explore what a put option in the stock market is, well more specifically in the options market, and understanding what a put is and how it works is going to be very important in times of market turmoil. Put options were created to give you a means, a way to ensure your investments, your portfolios, the stocks that you own. We're going to explore the ins and outs of it right now, so stay tuned. We're going to explore the risks, the rewards, how to utilize them. You're going to love it. So let's jump in. So to understand how put options work, we need to understand that it's a protective measure for stock holdings, stock investments that you own, is the first basic reason that put options were created. So when you think about stocks, stocks are an ownership in a business. Right? And you could have a portfolio of stocks. You could own A, B, C, and X, Y, Z, and we could make up symbols and so on, or we could put in real symbols. Maybe you own some Nvidia, maybe you own some Google, whatever. Right? So you have this portfolio of stocks. Now at various times you might be nervous about one or the entire portfolio, and this is where put options come in. The options market was created for two main purposes. One, and the first, was to be able to protect something. Two is to be able to generate income. And today we're going to talk about the protective side. And this is where puts, they'll often call them a protective put. And what you're doing is you're buying insurance. So think about how insurance works. When you buy insurance, there's really two parties, right? There's somebody insuring and somebody that's gaining insurance. Now, this might be a company that's offering the insurance. So let's say that this is Geico and they're going to insure your car. And over here, this is just a person, right? This is you. And you decide that, well, I just bought this $50,000 car. I'd like to make sure that if it gets totaled, I'm not out the 50 grand. So you're willing to send some money to Geico. And in the options market, they call this a premium. You're sending them some capital for them offering a big service to you. And that they're bringing in, if you look at Geico's side of things, they have smaller reward and bigger risk, right? They run the risk that they have to write you a check for $50,000 because that car was totaled. And they're bringing in, hundreds of dollars a year in the premium. So small reward for big risk. But what they have on their side is probability. Now the reason you want to transfer that risk to them is because you have big risk. You have a $50,000 car, and if it gets totaled, you're out the car. You don't have any money to repair it, so you need to send them a small, you have the big risk, you're transferring to them, right? And you're sending the small reward or the premium, you're sending the money to them, right? That capital. And so it's a transfer of risk. That's how the insurance company works. They're collecting money for taking on risks that you as an individual do not want to take. Now, that's very much what the options market is. That's what a protective put is. A put option says, I will draw a line in the sand and I will protect you from this spot down. And that spot is called a strike price. This is where the deal is going to be struck. So let's say that Nvidia is trading at 105 per share. And let's say that you decide that that line in the sand is $100. You do not want to lose more than down to 100. From below 100, you want to transfer the risk of Nvidia going down to someone else. You can literally send a premium to the put seller, send a premium to someone else, and they assume the risk on your stock from 100 on down. So let's imagine that Nvidia really gets hammered. And this stock, it starts at 105, but it finishes at expiration of this option all the way down at $70 per share. If it tanks to 70, guess what? You get $30 paid back to you per share. Why? Because you locked in the ability to sell at 100 and now the stock's all the way down at 70. If you can sell something at 100 that's worth 70, that's $30 of value. So did your stock actually go down that much? Yes. But see, they're sending you back money to cover the damages in your stock. Literally, that put option is going up in value as the stock price is going down. So the way your portfolio looks is, did your stock lose? Did your Nvidia stock go down? Sure it did. It went from 105 down to 70. You took a loss on the stock. But guess what? You had the put option. And your put option, maybe you paid $5 for it. It went from 5 in value up to 30. So your stock lost 35 points of value, but your put made 25 in profit. The difference between what you paid for it and what it's worth now, net, you only lost $10 per share, even though the stock price tanked by 35. And this is a huge advantage to you. Some might say, well, yeah, but you still lost some value. You still went down 10. Hey, you still own your shares. You still have 100 shares of Nvidia. Yeah, they went down some, but those shares can repair themselves. What if the stock then goes right back up to 105? Well, guess what? Now your stock loss is 0. It's right back to where it was, but you still locked in the 25 points from the put option. So this protection in a bad market environment, the ability and the knowledge to know how to go out and get some insurance on things that you own and transfer that risk to someone else, this is huge for you being able to stay ahead of the game. These are things that you cannot do in a 401k, and that's crying shame because stock markets don't just go in straight lines to the upside. So understanding how to go out and get some put protection at the times you need it is very, very important towards long-term ability to stay ahead of the game and to de-risk in a bad market environment. So we've explored what is a put option, we've talked about how the options market works and how you can protect your portfolio. If you like this video and would like more content like this, make sure you smash that subscribe button. Click the bell to be notified. Make sure you share this video around. It's great educational information, and we thank you for spending some time with us here today. We'll see you next time.